Hi, this is Alan Gassman, and we welcome you to this presentation entitled Economic Opportunity Zones, Strategies to Qualify Before December 31st, 2019. I'm here with my colleague, John Beck. John's done a lot of work on this PowerPoint this week and over the weekend. We've learned a lot putting this together, and we thank you for listening to us. Join us Thursday with David Finkel, 5 simple ways to increase professional practice profit by $50,000 or more. That's worth half an hour of your time. Christopher DiNicolo is going to cover Florida revocable trust debate, whether to have separate TBE or just trusts on Thursday the 24th. We'll be here with Michael Lehman on non-cash charitable giving part 1. Michael Lehman is a lawyer in New York City who specializes in charitable law. He's been helping us with some very interesting client matters, and we have some things to share with you, so that's going to be very exciting. And then we have some other things coming up that you have on the calendar here on pages 5 and 6. We have some LISI programs coming up. These do cost money. LISI charges for them, but if you want copies of all the outlines or you want us to cover anything particular in these LISI programs, please let us know. We really enjoy doing these programs for LISI because a lot of the people who listen are very challenging. It takes us quite a while to prepare for them, but we learn a lot. John Beck is the newest addition to our law firm. He's both a JD and an LLM, has his LLM in tax from the University of Florida, just like Brandon and I do. He's got an MBA also, and he's a really, really smart guy. So John, do you want to take this over and teach us a lot?
So economic opportunity zones are becoming more and more popular recently because if you don't invest in one by the end of the year, you won't get the full benefit. So this presentation will cover what is an economic opportunity zone, how to invest in one, the timing issues, because there are a lot of timing issues with this type of investment. And there are a lot of holding periods that you have to be aware of. And then we'll go through issues with administration and some other nuances that are involved with planning for economic opportunity zones. So what is an economic opportunity zone? The 2017 Tax Cut and Jobs Act created this. And unfortunately, when this was created, the statutes weren't that clear. So we had to rely on the regulations that came out. There have been a couple new proposed regulations that came out since passing this act, which provided some clarity. There are some things that we still are not clear on, and hopefully we'll get clarity on those soon, especially with the December 31st deadline coming up for one of the benefits that this kind of plan presents. And so what essentially this plan does is it designates different distressed areas, and in order to benefit, you invest in property or real or tangible property in the zone that they designate as being distressed. And essentially, the purpose is to improve those areas, to improve the economic conditions of those areas, and really to keep the money in that area rather than just having somebody improve it and leave. This is a great opportunity for people that have a lot of capital gains, and a few of the reasons why is it provides a lot of flexibility. Most type of businesses do qualify for these benefits, so we'll go over the ones that don't qualify later in this presentation, but most of them do qualify. There's no limit on investment, just that you need capital gains. And for most situations, this could be fairly easy, but we will go over some concerns that should be looked at before investing. And of course, there's a great tax benefit. You have deferral, reduction of capital gains, and you have tax-free growth on the actual investment itself. You also have some state tax benefits depending on which state you're operating in. Florida doesn't have an income tax just like Texas, so you won't really receive an extra state benefit. But you should look into this if you are considering an economic opportunity zone investment. Some states have programs that will assist with historic restoration, and that would fit nicely with a economic opportunity zone investment if that actual building was in an economic opportunity zone. And also, some states do couple their tax law with the federal law, so you want to look at that to see if you could get some added benefit there. There are a lot of the states who do provide for these similar provisions have opted out of the Economic Opportunity Zone program. For example, Hawaii decoupled for purposes of the Economic Opportunity Zone. New York is considering decoupling, and there's a lot of concern that these investments could actually have a negative impact on these communities, because as the value and business activity increases in these areas, the low-income individuals may be pushed out. So I kind of expect to see New York pull out of it, but we'll see how that goes. As I mentioned earlier, there are certain businesses that will not qualify for the Economic Opportunity Zone program. These are referred to as SIN businesses, and you can see them all listed right here, like racetracks, gambling, liquor stores. Those will not qualify. So investing in an Economic Opportunity Zone, there's...
Well, John, let me interrupt real quick just to make sure everybody understands this. If I have sold an asset and I would be paying a capital gains tax, then I'm able to roll that capital gain, so to speak, into an economic recovery zone investment, and then I wouldn't have to pay the capital gains tax next year.
Right. You would be able to defer payment on those capital gains until the end of 2026. You pay with your 2026 tax return, and you would also receive some reductions in that payment, up to 15% reduction.
So if I bought IBM stock and it went up and I sold it for $1 million and I had $300,000 of capital gains, would I have to invest the whole $1 million into the economic recovery zone, or just the $300,000?
Just the $300,000. And as we'll discuss later, it doesn't even need to be those specific funds. It could be property that you want to donate to the fund. So there's a lot of flexibility there.
Beautiful. Okay, sorry to interrupt you.
So how to invest, as Alan and I were just discussing, as long as you have capital gains, you can make an investment into an Economic Opportunity Fund. And the Economic Opportunity Fund is a special entity that is going to actually run the business or create a subsidiary to run a business in an Economic Opportunity Zone. Once you have capital gains, you have 180 days in general to invest those gains into a qualified opportunity fund or invest other property into that fund. But the 180-day rule is just a general rule. There are exceptions, and it can get much more complicated if you have, for example, a pass-through entity. Then there are different dates that apply, and the dates apply to different entities.
Now, let me say that there's going to be a lot of confusion because they call it a qualified opportunity fund. It could have been called a qualified opportunity entity.
It probably should have.
They should have just called it a qualified opportunity LLC, because you don't have to go to a stockbroker and invest in a fund, right? You could just do this on your own.
Right, as long as it's a partnership, S corporation or corporation, it can qualify, as long as you meet the requirements that we're outlining in this presentation and submit the proper forms.
Right, so I stole your thunder from page 16, sorry.
So just to go over this real quickly though, it is important to note that you do have to only be a partnership corporation or S corporation. It will not work if you want to do this as a single member disregarded LLC. So that's important to consider. You file Form 8996. It says you don't have to file it until you file your tax return, but it may be a good idea to file it beforehand just so you don't forget. And one thing I'd really like to highlight is the last bullet point on slide 16, that the Qualified Opportunity Fund should not be funded before the capital gains are recognized. Now, the statute doesn't specifically say this, but the statute does say you have 180 days to invest. I would not be comfortable investing before that 180 day, before the capital gains are recognized. And there are a number of reasons why that causes a lot of problems for people with timing. So, and we're going to go over that later on in the presentation. So there's also a requirement on how much the actual fund Qualified Opportunity Fund has to invest in the economic opportunity zone. And very strangely, the regulations and statutes state that if the Qualified Opportunity Fund is investing directly into the business, if it's conducting the business on its own, then it has to keep 90% of its assets in the actual economic opportunity zone. Cash contributed to the Qualified Opportunity Fund does not need to be invested into the assets for the first 6 months. So that first testing period, you won't have to meet that 90% threshold, but that is a pretty hard threshold to meet when you consider that just cash held in hand is not going to count towards meeting that requirement. So the one strategy that you could use is to have the QOF, the Qualified Opportunity Fund, open a subsidiary to run the business. The subsidiary only has to hold 70% of its assets in the economic opportunity zone. And as long as it holds 70% of its assets in that zone, then the parent is considered as holding economic opportunity zone property, and 100% of the value of the subsidiary will be considered as held in the economic opportunity zone for purposes of the parent entity. So I know that's a little confusing, but if you have a subsidiary, you just have to make sure you meet that 70% instead of the 90%. Another benefit to having a subsidiary is that there's a working capital exception. So if you have a lot of cash on hand in an account that's going to be used to invest into these assets, for example, if you're building, if you're constructing a building, you want to have cash on hand. You need to have cash on hand. So the regulations allow you to hold cash for up to 31 months as long as you have a written plan on how you're going to invest those funds into economic opportunity zone property. So we have a couple examples here of basically just about construction of a building using the 31-month period, so it's better to have the subsidiary here. So these percentages are measured at the end of every 6 months. And like I mentioned on the last slide, if you contribute cash in exchange for an interest in a Qualified Opportunity Fund, you don't have to meet the 70 or 90% test with that cash on the first valuation, the first date that it's measured. So you have at least 6 months depending on when you contribute the funds. A lot of people will be stuck to that minimum 6-month period because to get the 15% capital gains exclusion, they will have to make the investment December 31st of this year. So here, again, we just summarized the percentages and the 31-month working capital safe harbor. Just laid it out a little bit more cleanly here. And on the next slide, we have a chart showing how this would work. Here, I put in an S Corp. It could be a partnership or a C Corporation. The Qualified Opportunity Fund could be any of those three. And then it has a subsidiary underneath it. And this outlines all of the exceptions that I referred to in the last few slides.
So John, if I had a capital gain last month, then I would need to invest in a Qualified Opportunity Zone by December 31st.
That's
to both eliminate that gain and also what's the other thing that's in, if I don't meet that deadline? What if I do it in January? What's the difference?
So the capital gains that you're deferring until 2026, you will still qualify for the 10% exclusion on those gains, but after December 31st this year, you won't get up to 15%.
So you're talking about 5% of the capital gain in 2026. So it's not
correct.
So it's really not worth a big rush if I'm not going to get as good an investment.
Right.
But if all things are the same, I may as well do it by December 31st.
Right.
And do I have to actually buy something in the recovery zone, or do I just need to say I'm going to and put cash in an LLC?
You just have to say you're going to and put cash in an LLC. You'll have, if you do it December 31st, you'll have 6 months to reach the 90% or the 70% test.
So we're going to have a lot of December, I'm going to do it LLCs formed with a lot of cash put into them.
Right. And you still have a little bit more flexibility because when you file the form, you're basically just registering as an economic opportunity fund, and if it's filed with your return, you still have a few months to determine whether it's really going to be an economic opportunity fund.
And if you don't actually, if you set up the company by December 31st, you put the money in, and then you don't buy anything, you decide to pay the capital gains tax, there's nothing lost, right?
Right. Nothing's lost except you just paid the capital gains tax, which you would have had to do without this program.
Okay, great. Let's continue.
Quite a bit of flexibility there. There is a trade or business requirement. I know a lot of people would like to be able to just invest in raw land or other real property and hold on to it and then exclude all the gain in the future, but you do have to run an active trade or business, which applies the Section 162 standards. The new proposed regs were clear that this is the standard that must apply. There are some concerns that people might run some small businesses with a lot of land. That hasn't been adequately addressed. And you also should keep in mind the passive loss rules. So 469 could still apply to your business when you want to take a loss on your own personal return. Now, you also will be limited because the initial contribution to the fund is deemed to have a basis of 0. So initially, it won't make much of a difference that this restriction is in place, but as you build up basis, you have income that's not distributed, or you have debt that increases your basis in the entity, then 469 may limit your ability to take a loss deduction. And if you fail to meet the standards, there is a penalty, providing the calculation of the penalty here. You can see that the monthly penalty is the amount you miss your threshold by, whether that's 90 or 70%, multiplied by the underpayment rate, and that'll give you the monthly penalty. The underpayment rate is the short-term AFR plus 3%, so it's not huge, but it's definitely something to be aware of. So when benefits accrue, as we were referring to earlier, you have a 10% exclusion on the capital gains deferred, followed by a 15%. And the reason why you would miss out on the full 15% if you wait till after December 31st is you're only deferring until the end of 2026. So you won't have 7 years if you wait until January 1st of 2020. And then the big benefit here is the investment can appreciate as much as you could get it to appreciate without that appreciation being taxed. So this has an added benefit because of the way the statute is written. Because your basis is increased to fair market value when you sell after 10 years, you shouldn't have depreciation recapture either.
That's remarkable.
Mm-hmm.
But again, so if I put my $300,000 in January because I had a $300,000 capital gain, then after December 31st, 2019, I still have to recognize 10% of that capital gain.
You'll recognize 90% of the capital gain. It's reduced by 10%.
I see.
So you defer for about 6 years, and then you also get a 10% discount, and then you also get the free appreciation essentially on your actual investment.
Okay.
It's not working. Okay. So there are some issues investing in an economic opportunity zone. I mentioned the zero basis issue previously. I think this is one of the biggest negatives because you're essentially locked into this investment until you have some basis, or else you could suffer some really negative tax consequences. So that's definitely something to consider. And also, even if you think about taking out debt to increase your basis, you might run into the issue of having a deemed sale. So something to definitely consider before investing into an economic opportunity fund. We already talked about the 10 versus 15%. And even though the statute says that as long as you hold the property for at least 10 years, the gain on that economic opportunity zone property is tax-free, it's not forever. The proposed regs came out and said it ends at the end of 2048. So you do have a long period of time for tax-free growth on your investment, but it is limited. Also, the proposed regs did address one issue that professionals were bringing up, was what happens if the taxpayer dies. It's not clear whether you'll have a step up to fair market basis, but the benefits of the economic opportunity zone will continue. So that is something to consider. And when using a pass-through entity, we alluded to this earlier in the presentation, you do have to be cognizant that the timing of the investment is more complex. There's different rules that apply. So first, the pass-through entity can elect to defer their capital gains through investment in a qualified opportunity fund. The pass-through entity has 180 days to do that, and if not, then the shareholders can. But the shareholders can also elect to use the date of the sale that was made by the pass-through entity to defer those projected gains. So there is always a risk that the pass-through entity could just invest into an economic opportunity zone after the shareholders already elected to do so. I don't see anything that would prevent the pass-through entity from doing that, and then the taxpayer's investment may not qualify. But one of the great benefits here is that if the pass-through entity does not enter into an economic opportunity zone or economic opportunity fund, then the shareholders receive their K-1s on December 31st, and they can invest at that time. And the 180-day period will begin on December 31st, giving them to about June 30th. So people with partnerships and S-corps do have quite a while to determine if they want to invest in these types of funds. Then, the next slide, I just give an example. I essentially covered almost all of this on the last slide. It's the same for partnerships and S-corps. That 180-day period will still qualify. I would recommend that if you want to make an investment into a qualified opportunity fund and you're receiving capital gains from an S-corp or a partnership, to enter into an agreement with the pass-through entity. That way you can have some confidence that the pass-through entity will not itself enter into an economic opportunity zone investment. And you should always consider your own personal capital gains and losses in addition to what you receive from the pass-through, just to make sure that you have net capital gains and that this investment will be worthwhile for you. Of course, when you use a pass-through entity, as we mentioned before, the zero basis rule is going to have an effect. It's going to affect your distributions. It's going to affect your pass-through of losses. And there are provisions that that cover what happens when a partner or a shareholder sells their interest in one of these qualified opportunity funds. For partnerships, the partner will lose their deferral and will have to pay their capital gains tax, subject to the discounts that we talked about earlier, the 10% or the 15%. And another partner can come in and purchase that investment, and they could potentially qualify as investing in an economic opportunity zone, but it seems pretty clear that their holding period will start over. So they would have to meet the 7-year and the 10-year requirements in order to really receive a benefit. 1231 property is also a little bit more complicated. So when dealing with 1231 property, so if you have a gain or loss, if the gain is treated as ordinary income, it will not qualify for the economic opportunity zone investment. So the second bullet point, if loss is used to offset the ordinary income in 1 year, then the 1231 gain will be deemed as ordinary for the next 5 which means it will not qualify for a qualified opportunity fund type of investment. But if it is taxed as capital gains for the taxpayer, then the taxpayer can receive the benefits of an economic opportunity zone. So one of the more favorable provisions of the new proposed regulations are that they specify that cash and assets can be contributed to a qualified opportunity fund. So you can invest a building that's already in an economic opportunity zone that you purchased before this statute was put in place, and you could qualify, but you have to remember that you would lose your you would lose your basis in the property. Your basis will be deemed your contribution to the entity. So that's always something to consider when contributing the property. And when you contribute an asset, you might have a gain if you have a value, fair market value that exceeds basis. So it might be a little bit more complicated to contribute assets, but for somebody that doesn't have the cash, maybe they received a bunch of capital gains but had to spend those funds on something else, this could be an option. Okay, for property purchased before December 31st, 2017, you generally would not qualify to use that property as an economic opportunity zone investment. But like I mentioned on the prior slide, you could invest that into a qualified opportunity fund, subject to all the same rules that would apply to cash. But there's another option. You can enter into a related party lease. So if you own property in an economic opportunity zone, you can open up another entity and you can have a lease that's at arm's length between the two entities, as long as you don't prepay your rent by more than 12 months. And you don't have to substantially improve it, which is another benefit with leasing. And that even applies to related party leases. So there is a way around this, this restriction, just a little bit more complicated and takes a couple of entities. And leasing property in general, one of the benefits of leasing is that you don't have to meet the substantial improvement or the original use test, which we will discuss in more detail shortly. But you do have to still meet that 90 or 70% minimum economic opportunity zone property requirement. So leasing can be a great option, especially for a small business that doesn't have the capital to invest in improving the property. And that's only for real property. If you are investing in tangible personal property, then you have to substantially improve it or acquire other tangible personal property that's original use property in order to meet the threshold. So there's a great benefit for leasing real property. For tangible property, the benefit is not that great. And the original use requirement, basically the property that's contributed to the Qualified Opportunity Fund or purchased by the Qualified Opportunity Fund would have to be first used in the Qualified Opportunity Zone for the business purpose that it's currently functioning under. So if you purchase a house, you convert it to a laundromat, then you can qualify as original use. But if you you're probably going to meet the substantial improvement test if you do that anyway, but the same thing for tangible personal property. If you're leasing a tractor, if that tractor was first used outside of the economic opportunity zone, then it would not qualify as original use property in the economic opportunity zone.
So if I buy a bowling alley in an economic opportunity zone, that doesn't work because it was already there?
Correct.
I have to buy something and then convert it or build onto it.
Right.
So I couldn't just buy an apartment building in an economic opportunity zone?
Unless it was vacant for 5 years. There is an exception for that.
Could I buy an apartment building and then build on, add to the building, add a third floor?
As long as you invest an amount equal to what you purchased the building for. So as long as capital improvements equal your purchase price, then you'll qualify under the substantial improvement test.
But your purchase price doesn't include what you pay for the land.
Correct.
So if I buy a land and building, the land is $500,000, the building's $200,000, I pay $700,000, then I have to put another $200,000 in improvements.
Yep.
To qualify. So nowadays we'll be allocating more to land.
Right.
In the old days we wanted less to land.
And that's another way the mechanics of this also encourage that, because you have zero basis to begin with, so you're not going to be depreciating that building right away. Only your additions to it can be depreciated.
And John, how much longer do we need to finish this? Because we told people 30 minutes. I'm going to go ahead and email everyone a transcript of what gets said from here on.
I have
about 5 more minutes.
2 more slides.
Oh, great. Okay, good.
So raw land, there is a concern with raw land because one concern would be that somebody would purchase 10 acres of raw land in an economic opportunity zone and essentially open a lemonade cart and say they're running an active business. It's unclear exactly how we're going to, how the IRS will deal with that, but we expect that there will be some guidance provided. If you look at some of the commentary that was released with the proposed regs, it definitely is on the IRS's radar. So I wouldn't recommend performing or entering into any of these kind of deals. It should really be a substantial business. And then installment sales, we believe that the capital gain for installment sale purposes will be recognized when it's received and can be contributed to the Qualified Opportunity Fund at that time. This does provide some added benefits because if you're selling a business and you want to build a massive building in a Qualified Opportunity Fund, you can have that income stream contributed to the Qualified Opportunity Fund as you receive it, reducing the amount of cash that's held and making it more likely that you don't fall behind on the 70 or 90% requirements. And then here, since we're in Pinellas County, I just included a map of the economic opportunity zones in Pinellas County. You can find similar maps essentially for the whole country. There's thousands of these zones across the country, so there's likely some nearby you. And that's all we have for economic opportunity zones.
Okay, very good. Now, one thing we've learned is that almost all of downtown Clearwater, almost all the area around the Tropicana Field in St. Pete, and almost all of the area near Channelside in Tampa are opportunity zones, even though those places are not blighted and don't have any economic problems at all, because apparently these zones were laid out about 10 years ago. So there is a tremendous opportunity there. And, we often see people come and do things for strange things to avoid taxes. But this looks like a legitimate opportunity as long as you have a business or you have a real estate-based trade or business that you can originate in this zone to eliminate your capital gains tax. It looks like a pretty nice opportunity.
Yeah, definitely is.
And of course, Wall Street will be manufacturing large prospectus-based opportunity zones where the opportunity may be mainly with the salesperson who gets you to go into it.
Right.
So we hope more people will set up their LLCs by December 31st, put their money in, and then take their time in deciding what to buy.
Right.
Did you mention the 1231 rules?
Yes.
Okay.
Yeah, we have a separate slide on that.
All right, well, we thank everyone for attending this presentation. I know that you would much rather be out on the beach, so there's the volleyball net, just getting ready. John and I are about to go out there and play some volleyball, but in the meantime, please join us Thursday with David Finkel, and then a week from Thursday with Christy Nicola, and then 2 weeks from Thursday with Michael Lehman, and all these other nice webinars we have coming up. Send any questions, comments, or suggestions about this presentation, or especially questions about economic recovery zones, to john@gassmanpa.com. And if you have any praise, you can send that to agassman@gassmanpa.com. Thanks again, and may the rest of your afternoon be billable.